Hello and welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week we step back from the noise to unpack the developments shaping credit, explore the macro forces behind them, and discuss what they mean for investors and issuers across Europe and the UK. Today we're covering three major stories defining this week's market narrative: a new EU agreement to harmonize insolvency rules, a structural step toward a more integrated European capital market, the European Commission's infringement procedure against Italy's Golden Power law, reigniting the debate over cross-border bank consolidation, and finally, expectations surrounding the UK's much-anticipated budget as investors weigh fiscal discipline against the need for growth. All right, let's get started. One of the biggest obstacles to deeper European capital markets has always been fragmentation in insolvency regimes. When investors lend across borders, they face 27 different national procedures with inconsistent timelines, creditor rights, and recovery outcomes. It's a persistent deterrent to cross-border capital flow. Unlike the United States, which has the unified Chapter 11 system, Europe's corporate insolvency landscape remains a patchwork of domestic laws. That uncertainty raises costs, prolongs restructurings, and weakens investor confidence. Now, a major shift is underway. On the 19th to 20th of November 2025, the Council of the EU and the European Parliament reached a political agreement on a directive on the harmonization of certain aspects of insolvency law, a key part of the Commission's Savings and Investment Union agenda. This builds on the earlier Restructuring and Insolvency Directive from 2019, but goes much further in unifying practical rules that affect creditor recoveries. Financial institutions remain outside the scope. Banks already fall under the Bank Recovery and Resolution Directive, or BRRD, but for non-financial corporates, this marks the most ambitious step yet toward a common insolvency baseline. The new directive introduces several major reforms: uniform guidance actions, empowering authorities to unwind or claw back asset transfers made shortly before insolvency, closing a major loophole in national regimes; cross-border asset tracing, granting insolvency practitioners EU-wide access to data such as bank account registers, beneficial ownership records, and property databases; pre-pack sales, which allow companies facing insolvency to pre-arrange a sale of viable business units as going concerns, helping to preserve value and jobs. Director duties and timely filing. These are requiring directors to file for insolvency within 3 months of becoming aware, or when they should have become aware, of insolvency risk, unless they take equivalent measures to help protect creditors. Creditor committees. These are established in substantial cases to represent all creditor classes and help to advise courts on major restructuring decisions. The transparency and access, which will compel every member state to publish a fact sheet in English, French, German, and the national language, summarizing its insolvency laws, which helps to reduce informational barriers for both investors and insolvency practitioners. The goal is to help improve efficiency, consistency, and predictability of insolvency proceedings, creating a legal environment where outcomes vary less by jurisdiction. That in turn should support cross-border investment, lower borrowing costs, and strengthen creditor protection. The directive doesn't replace national laws. It sets a minimum common standard allowing stricter regimes where desired, but ensuring weaker frameworks are lifted up to a higher floor. The European Commission argues that this will help to foster investor confidence, preserve enterprise value, and strengthen Europe's capital markets. As with most EU reforms, patience is required. Once formally adopted, member states will have 2 years and 9 months to transpose the directive into domestic law. If ratified in early 2026, that would mean full implementation by 2028 or 2029. A realistic time frame, if not an urgent one. So, as a result, progress, slow but meaningful. Shifting to banking, where integration has long been more aspiration than reality, The European Commission has launched an infringement procedure against Italy over its use of the so-called Golden Power rules, laws that allow governments to veto foreign takeovers of strategic domestic assets. In theory, these powers are meant to shield critical infrastructure from non-EU acquirers. In practice, Italy's government has increasingly applied them to intra-EU bank mergers, and Brussels has taken issue. The Commission's formal letter of notice, sent in this November, cites potential violations of the Treaty on the Functioning of the European Union, specifically Articles 49 and 63, which guarantee the freedom of establishment and free movement of capital within the single market. It also references conflicts with the Single Supervisory Mechanism regulation, under which the European Central Bank oversees large banks and in the euro area. At the heart of the dispute is Italy's intervention in several proposed banking transactions, including actions related to Unicredit and Banco BPM, where Rome used its golden power to impose or block conditions not directly linked to national security. The Commission argues that these measures overstep the legitimate scope of the law and create legal uncertainty for cross-border mergers. Italy now has 2 months to respond and propose amendments before the case escalates to the European Court of Justice. Prime Minister Giorgia Meloni's government defends its use of the mechanism as necessary to protect financial stability and domestic employment, but for Brussels the issue is clear. National governments should not use strategic asset laws to shield domestic institutions from European competitors. This isn't just a legal squabble, it's emblematic of a much bigger tension. Europe says it wants cross-border bank consolidation to create larger, more competitive financial institutions capable of supporting investment and competing with global peers, but national politics repeatedly intervenes, prioritizing sovereignty over scale. The European Commission, echoing the European Central Bank, has made clear it sees consolidation as essential to strengthening the banking union. As the Commission put in its notice, a truly integrated banking market requires open, competitive conditions for intra-EU mergers. For now, the challenge to Italy marks a significant test. If upheld, it could clarify where national discretion ends and single market law begins, a boundary that will help to shape Europe's financial landscape. Now, lastly, the UK prepares for one of its most closely watched budgets in years. Even before Chancellor Rachel Reeves delivers her statement, speculation has dominated headlines. The central question for investors: will this budget restore fiscal credibility while supporting growth? The resulting budget will be out by the time you have read this. Much of the focus ahead of time centers on fiscal headroom, the buffer between the government's self-imposed fiscal rules and the Office of Budget Responsibility, or the OBR's, forecast for spending and borrowing. It's a simple measure with outsized importance. The larger the headroom, the more credible the government appears to bond markets. According to a recent Financial Times article surveying investors, bondholders are watching two main things: how much fiscal space Reeves leaves under the OBR's baseline scenario, and whether her spending plans are matched by structural reforms to support productivity and investment. In other words, discipline first, ambition second. Some investors fear the new government will lean on cosmetic adjustments, minor tax shifts, or rebranded programs without tackling deeper inefficiencies. Others believe Reeves will use this moment to re-establish credibility after years of fiscal volatility, particularly following the 2022 Truss Kwarteng episode that shook the gilt markets. The broad tone among credit investors in the article is cautious optimism. If Reeves can strike a balance between prudence and pragmatism, maintain headroom, and signal reform intent, the market reaction could be constructive. The UK's challenge is less about fiscal arithmetic and more about restoring trust with investors and with the public. As a UK taxpayer, I'm hoping for bold reform, particularly around regressive taxes that hold back growth, but experience tempers optimism. Britain's political culture tends towards incrementalism. As ever, keep calm, carry on, and balance the books. So, where does that leave us now? As Thanksgiving week brings a lighter tone to U.S. markets, Europe remains the main stage for macro developments. Equity markets have wobbled recently, but European credit spreads have held remarkably steady, a reminder that despite global uncertainty, underlying credit fundamentals remain strong. Corporate balance sheets are resilient, default rates are contained, and liquidity remains accessible. The Insolvency Directive's passage, while not immediately market-moving, adds to the long-term structural support for European credit. Greater legal predictability, improved recoveries, and deeper cross-border participation. Meanwhile, the EU's pressure on Italy could over time revive momentum for banking union, a project often delayed but never abandoned. Both reforms point in the same direction, incremental steps towards integration, driven not by crisis but by coordination. Still, nothing in Europe moves quickly. Implementation will take years, political resistance will persist, and differences will remain. But the trend line is unmistakable. Europe is slowly building the legal and institutional foundations of a true credit union. One directive, one court case, one market rule at a time. Yes, each of these stories reflects a broader truth. The credit landscape evolves through steady structural change, not grand gestures. Integration and confidence are built brick by brick. That's all for this week's edition of the Credit Compass. For our American listeners, happy Thanksgiving. Enjoy the break. If you found today's discussion useful, follow, rate, and share the show. It really helps others to discover it. And if there's a topic you'd like us to explore, please drop us a line. We're always open to listener ideas. For deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macrocredit, our dedicated hub for all things macro, markets, and credit dynamics. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.